Hey everyone, welcome back to Corporate Decoder. Today K.A.P.A just filed their quarterly report for the 31st of March 2026, and I am seeing one really interesting trend that matters. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing a significant increase in cash burn, and it looks like they are leaning heavily on stock sales to stay afloat. This is Kairos Pharma, a biotechnology company focused on cancer treatments. They just released their quarterly report, and like many companies at this stage, it's a mixed bag of hope and financial reality. Let's dive into the numbers. For the first 3 months of 2026, Kairos Pharma reported a net loss of about $1.7 million. This is up from a loss of $1.3 million in the same period last year. So they are losing more money as they progress. Their operating expenses also went up from $1.3 million to $1.7 million. This rise is mainly due to increased spending on research and development and general administrative costs. Specifically, research and development costs jumped from $493,000 to $684,000. This increase is tied to their ongoing clinical trials, like the phase 2 trial for prostate cancer. It's good they are investing in their pipeline, but it also means more cash is going out the door. General and administrative expenses also saw a hike, going from $773,000 to just over $1 million. Part of this increase is due to being a publicly traded company, which comes with higher costs for things like legal and accounting services. Now, let's talk about cash. As of the 31st of March 2026, Kairos Pharma had around $3.7 million in cash and cash equivalents. This is down from about $4.5 million at the end of 2025. This decrease in cash is directly related to their operations. They used about $1 million in cash for operating activities in the first quarter of 2026, compared to $714,000 in the same period of 2025. This shows their burn rate is increasing. To counter this cash burn, they are actively raising money. In the first quarter of 2026, they raised about $385,000 through an at-the-market, or ATM offering. This means they sold newly issued shares directly into the market. Looking back at 2025, they also had a private financing round where they raised about $3.1 million. These are crucial for keeping the lights on, but they also mean existing shareholders are getting diluted. The company itself acknowledges this. They state that based on their current cash levels and planned expenses, they might not have enough to fund operations for at least the next 12 months. This is a classic going concern warning. This situation is similar to what we saw with Bed Bath & Beyond, which ultimately filed for bankruptcy. While it is not a guarantee, it highlights the risks when a company heavily relies on continuous fundraising to stay operational. Another example is Tupperware, which has also been struggling with liquidity. Their strategy to raise capital through issuing more shares does lead to dilution. The number of weighted average shares outstanding increased from about 15.9 million in early 2025 to just over 21 million by March 2026. That's a significant increase in shares, meaning each existing share represents a smaller piece of the company. The company has over 100 million shares of common stock authorized. This large number allows them plenty of room to issue more shares if needed, though it also means potential for substantial dilution for current shareholders. They have also used share issuances for things like vendor payments and deferred offering costs, which is a way to conserve cash but still increases the share count. You'll also see deferred offering costs on their balance sheet. These are expenses related to raising capital that get capitalized until the offering is complete. The company has over $1 million in these costs, showing they have been actively trying to raise funds through various agreements like an equity line of credit and an ATM offering. On the asset side, they have a small amount of intangible assets, mainly from a licensing agreement. These are being amortized over 5 years. It is not a significant part of their business right now. Their shareholders' equity has decreased from about $6.3 million at the end of 2025 to $5.3 million by March 2026. This is largely due to the accumulated net losses they've incurred. Looking at the broader picture, Kairos Pharma is in a highly speculative phase. They are developing cancer treatments, which is a critical area. However, the financial reports show they are burning through cash and relying on equity financings to survive. Recent news mentions they are presenting at the LD Micro event, which is typical for companies seeking funding and investor attention. While they have over 21 million shares outstanding now, the authorization for 100 million shares means there is a lot of potential for future dilution if they need to raise more capital. Their strategy seems to be pushing forward with clinical trials while constantly seeking new funding. The question is, can they develop a successful drug and reach profitability before they run out of money or dilute their shareholders too much? The company's focus on immunotherapy and cell therapy is a promising area, but the path to market is long, expensive, and uncertain. We saw a similar pattern with companies like Exometry, which has faced its own challenges in scaling up while managing operational costs. My biggest concern is the increasing net loss coupled with the significant cash burn. While investing in R&D is necessary, the reliance on ATM offerings and other equity financings at this stage could signal a difficult road ahead for current shareholders. I will be looking for any signs of progress in their clinical trials that could lead to significant partnerships or revenue. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives.